Hello, thank you for joining Techie Personal Finance Bootcamp. And if you missed the very recent episode, I'm actually not taking a break at this point. I guess this is a continuation of season 1.5. So I'm right into tax season. I'm super excited because I know there's a lot of planning opportunities, both for level up financial planning clients as well as the power up tax planning services I just recently launched. And basically, you only get these small increments in terms of years to take advantage of your situation. So it's helpful to actually understand how best to efficiently plan for your taxes, make sure you're not paying any more than you need to, and then have a good understanding of how 401k contributions or IRA contributions or even withdrawals that you may need to make during the year. All these things kind of have different strategies you can implement to make sure you're not paying more than you need to, and just have a good understanding. And because everyone has to pay taxes, it's good to just get a baseline understanding of some of the basics. So hopefully these videos will be helpful. So one of the things I want to talk to you about today is going to be the difference between deductions and credits. So the biggest difference is deductions only reduce your income, which is not as valuable as reducing your taxes. So when you reduce your income, you're taxed at a percentage of the income. So really you're only saving a percentage of the income that you are deducting. So if we say that you are able to deduct $1,000 from your income and you're in the 22% bracket, that's going to save you $220. So that's how, just a quick example of how a deduction would work. When we look at credits, credits are pretty cool because they actually are dollar for dollar reduction in taxes. So if you receive a $2,000 tax credit, which is just an example of the child tax credit, if you receive that $2,000 tax credit, you actually receive $2,000 less in taxes as a result. So that's the difference there. Deductions are not nearly as powerful. Obviously, they're still helpful because they help reduce your taxes, but the credits are going to be way more valuable. With credits, they tend to be phased out depending on your income levels. Luckily, the child tax credit is actually, that phase out limit has increased substantially back in 2017 when they changed the tax system pretty substantially. So if you maybe 2 years ago didn't qualify based on income for the child tax credit, you may want to double check because you may be qualifying now because the income phase outs have increased so much. We can also just quickly talk about itemized deductions and the standard deductions. So standard deductions, those increased pretty heavily back when they did the tax reform 2 years ago. And so your standard deduction for 2020 would be $12,400 for an individual or $24,800 for married filing jointly. And so that's important. One of the reasons why those increased because they did away with exemptions. So exemptions used to be a very popular phrase in taxes, but now it no longer exists. Actually, to the point where on your W-4s, you don't even claim exemptions anymore. And that started in 2020. They were about 2 years behind in actually updating your W-4 that you submit to your employer. With those higher standard deductions, it's made it very unlikely that many people will actually do itemized deductions anymore. So with itemized deductions, you really need those itemized deductions to be higher than the standard deduction in order for them to make sense. So things like property taxes and your state taxes that you pay on income, like those things, if they don't cross that threshold to where you're able to actually use them as a itemized deduction, they're not really as meaningful as they used to be. And I know a lot of people sometimes would use the excuse of purchasing a home as, hey, I'll be able to deduct the property taxes and things like that, which yes, if you are itemizing your deductions, that would still be true, but so many people are just not going to be itemizing anymore because those standard deductions are so high. There's also a unique thing called state and local tax where there's a cap at $10,000 in that itemized deductions. It really hurts people that have high property taxes in the area that they live or high income taxes. So California and New York are really popular states where they were not happy with that cap on the state and local tax at being 10,000. So, and those are nicknamed or called SALT for state and local tax. So that's important to know. Just when it comes to itemizing, you may have been itemizing in the past, but you may not be doing it moving forward just because the standard deduction increased so heavily. Well, hopefully that's helpful with the quick understanding of how deductions and credits kind of work.